Hey everybody, Scott Riley, the Market Update Desk. Welcome to a new week, a new month in the beginning to the end of the first quarter. Got a whole lot going on. We are back in the studios today. Knees starting to feel a lot better, and we are firing on all cylinders here. So stocks and bonds are a little weaker to start the week. Now, a lot of different factors within the stock market going on, but in the last month and a half, we've seen almost a 0.5% drop in mortgage rates. So the slowdown in the stock market has been helping us in the bond market. Now, today, we got very good news or information that the market's reacting to from Treasury Secretary Bessent. Now, he was recently interviewed and had some very optimistic comments on housing and rates and the economy as a whole. Let's break down what was said and how the market's reacting. So Bessent said he believes the U.S. will achieve its 2% inflation goal due to policy changes within oil, reducing the U.S. deficit, partly to do with Doge. This is not a political statement. It's just a commentary on what he said. Now, he also expects and wants the 10-year Treasury yield to move lower and believes that the spread between mortgage rates and the 10-year bond will continue to narrow, maybe back to a more traditional spread. Now, those were very good news for mortgage rates. On housing, it's probably a little bit over enthusiastic, I would say. He believes that the housing freeze will unlock, his words were, in a few weeks. Well, I don't believe in a few weeks. Maybe we'll get some unlocking as we go through the spring and summer buying season. This would be a welcome development for all of us. Now, as we move forward, also what he talked about was, as far as Treasury issuances, they're going to be more on the shorter term than the longer term issuances. And the 10-year bond really like that. The less amount of inventory in the 10-year bonds did help rally the bond market. Now, some interesting news out of the Atlanta Fed recently. They released their GDP estimates for Q1 2025. First, for perspective, the Atlanta Fed was originally forecasting 2.9% growth just a few weeks ago, then 2.3% growth on February 14th. And just last Friday, on their GDP Now estimate, which is updated continuously, that February 28th report reduced it from 2.3% down to a negative 1.5%. That's a big change. So they cited concerns over the most recent PCE report, which in honesty came in neutral and was not that bad. The issue was it saw spending drop all the way to negative 0.2. They're likely feeling that the consumer is starting to be tapped out and extrapolating that into the models. The signs are recessionary and could lead to the Fed changing their tune on rate cuts. Additionally, keep in mind, a slower GDP growth helps us out a lot on mortgage rates. So there's a lot going on here that could start to be a movement, a trend to the better side of mortgage bonds and mortgage rates. President Trump also last week indicated that he did an executive order on digital assets directed there be a presidential working group to move forward on a crypto strategic reserve, which would include XRP, Solana, Cardano, Bitcoin, and Ethereum. So there's a few of those that if you followed the market on Friday, specifically, I think it was XRP and Solana, rode up very nicely. Now, at the end of last week, we did see a dip in a couple of the cryptocurrencies, but we're now seeing that those jump back up as of this morning. So very interesting there. Realtor.com just reported in their February days on market dropped 10%. As we're now getting closer to that all-important spring and buying season. This is why we've been so adamant of talking to our buyers. Don't wait for spring. If you do, you're going to have multiple more competition and offers to compete against. And you're going to have probably higher bid over ask price as more and more offers start to come in. Now, this week is a very important week. Again, we get jobs week. Wednesday, we get mortgage applications, ADP jobs report, and the Fed's beige book. Thursday, initial jobless claims, and we are also going to start to prep for the BLS jobs report on Friday. So very, very big day. The market's expecting between 140 and 150,000 jobs created in February, and is looking for the unemployment rate to remain at 4%. Mortgage bonds have been on a roar over the last few weeks. But after breaking above top end resistance of 101.55 on Friday, they did pull back beneath that level this morning. They're near support of 101.39, but they're staying pretty steady this morning. It's been a nice uptrend. We'll see what we get. 10-year bonds tested the 200-day moving average as resistance this morning, and that is holding. If yields can remain beneath this level, there's some room to the downside to get us to a 10-year of 4.126. That would give us continued better mortgage rates, especially going into the buying season. Give us a call. We've been working all weekend. We've got more buyers pre-approved. So the phones have been a lot busier the last 3 weeks. Don't get left behind. Don't let the wave crash on you. Ride the top of that wave. Get ahead of the buyers. Use our market knowledge to help you get pre-approved, help you get the best loan, and negotiate the best opportunity on your next house. Give us a call, 616-293-2189, the Market Update Desk, your original singular market news source for West Michigan.